Okay, can everyone see my screen?
Yep.
Okay, cool. Before I start, any questions from the previous sessions? Okay, we're good to go. Okay, so last session we did a little technical stuff. We got into how these machine learning algorithms work and what is the underlying process they work with. But this is an investment class, right? And in the end of the day, we're trying to like look at the ways that we can make winning investments. And to do that, I prepared that this is going to be a somewhat of a short and just an overview with like one practical experiment of how we can utilize those same algorithms to look at the market and like generate excess returns and what are the issues, what is the current state of the industry. These are the general things we're going to talk about. Now, before I get into the actual application of it, we do kind of need to review a few of these like fundamental asset pricing concepts. Um, and I want you to like answer all these listed questions here. And we'll talk about those a little bit before we get into the machine learning's role and all these stuff. So what is the value of a firm? What is the like the price you're paying? What are you paying for?
The underlying assets of the firm.
True. What else? Like Tesla, you buy Tesla, like it doesn't really have that much asset now. What are you buying?
Future cash flow.
Cash flows.
Correct. You're correct. So like the idea, like at least theoretically speaking, is like whatever you're buying today is the combination, whatever value you assign to the firm is the combination of its current assets and dividends combined with it like potential cash flow it's going to have in the future and the growth it's going to have. Now, how accurate is all that? Like that's irrelevant to this, but the general idea is there. Like we're buying something because it's either paying us dividend right now or we believe that it's going to like pay a lot of dividend in the future. That's the general consensus of it. Now, what is market efficiency?
I guess we could define that in two ways. I guess one way to look at it is market efficiency is saying that the market is responding to all available news and making sure that the true value of the firm is reflected. That's one way you could look at it.
That's correct. What is your other way of it?
I mean, in terms of efficiency, I would think maybe, I don't know, the market or I guess the economy is operating at some sort of optimal level, but that can be subjective. So that bit is harder to answer, if you will.
Yeah, very well said, Ro. So, like, answer this follow-up question as well, because that your definition is correct. So will you be able to make a profit in a fully efficient market? Like, imagine it's fully efficient. Every information is reflected in the price.
I mean,
would you be able to make a profit?
I do think you should make a profit, but depending on when you get in, it might be minimal.
Would you be able to beat the market?
I don't.
Not necessarily, I wouldn't say.
Yeah.
I think so.
Because
So,
I mean, I was
go
just going
ahead.
to say you could have a company that you could, I guess, find out if a company is capable of performing and keeping up with the performance of the market in a truly efficient market, and find out whether it can maintain a healthy bottom line, so to speak. So you might find out it's not a profitable, valuable firm.
Yeah. Yeah, you're right. So the idea is that like if the markets are fully efficient, that means that every information there is, every analysis like Matt is going to do, Hugh is going to do, I'm going to do, all of that is already in the price. So there's no point. After that, it like they're theorizing like whether it's a random walk or not, and that doesn't really matter. But the idea is if everything's fully efficient, you're generally not supposed to beat the market. But we know like in practice we have inefficiencies and we have mispricings. Now the general idea of like mispricing, whenever you say like this asset is underpriced or overpriced, what do you mean by that saying? Anyone can jump in on that?
I mean, it's not reflecting, like Brian said earlier, maybe the underlying value behind the assets of the company. Maybe there is some information that people are not seeing. That's one way to look at it.
Okay, so yeah, so in a fully efficient market, all the information, and this is like what we call an homogeneous expectation. Imagine like if everyone has the same view and all the information is reflected in the price, you're not going to be able to find an underpriced or overpriced asset. And the only way you're able to like make a profit is that if you're going to buy something that yet no one else or like not the majority of people have realized that it has value. Imagine like you want to jump into Tesla like 3 years ago and the price is, I don't know, like $50. Let's say, I'm not sure about that exact number, but you value the firm like with your analysis, you're familiar with the industry, and you say this Tesla should be worth $600, and that's the reason I'm going to buy it. It's not 50. That 50 is wrong, right? If everyone else thought like you did, they would immediately buy Tesla and they would push the price up to that $600 in like 3 seconds. So, and that's why we like Hugh and Chuck like are very firm on that aha moment, because if the idea that you have is not really original, and not by original I don't mean it like you're the sole person who has it, but like if everyone else has that idea, that generally doesn't really going to realize return in the market, at least in an excess form where you would like be able to beat the market with that idea. So let's cover another hypothetical situation. Now, let's say you beat the market, you generate like 30% return, 20% return, and over the past year, and you've beat the markets. And how would you know that it's because of your ability, your industriousness, or is it just that like you're basically taking more risks? How would you account for that? Let's say like I beat the market and I had like 30% profit, but the only asset I owned was Bitcoin. Would that be a fair comparison to someone who owns S&P 500 and I would go tell them like, look, I'm a better trader than you? Would that be like a fair conclusion out of that scenario?
I would say no. Until you're able to replicate that particular phenomenon, I would say no. And we also gotta speak to some extent about diversification if we're talking about investing. So I would argue that you might be making higher returns, but in the long run, unless you can keep that up, I would say that your way shouldn't necessarily be what you're preaching.
That is correct. But why am I exactly making the wrong comparison here? What is the main underlying difference between S&P 500 and Bitcoin among many of them, with the like comparing returns of them?
I mean, there's a way to value the underlying value of the S&P 500 and its components, and Bitcoin is a bit harder to value or quantify.
That is true as well, but I'm looking for something else as well. It's right in the slides. Anyone else cares to jump in?
Bitcoin doesn't, I don't know.
So,
they are
Go
two
ahead, please.
separate commodities. Like Bitcoin is like a digital currency and S&P 500 is like more of an index. So the risk associated with one is more than the risk associated with the other.
Thank you. Yeah, you are very correct. Like Jasmine, like the idea is like we have a bunch of different factors and like a whole lot of economists have theorized, but the main thing you need to take into account is what we call like a general idea of like CAPM is based on that, to a risk premium. The idea is that like if you're having excess returns by simply having more risks, that's not really your skill. You're just more risk tolerant. And that comparison is that like, and that's why whenever like you're trying to backtest a trading strategy, a systematic trading strategy, or even like compare like different fund performances, portfolio performances, the idea is that like you need to compare apples to apples. You cannot really compare it like a Bitcoin portfolio, a crypto portfolio to S&P 500 or to treasuries, right? You can't really say like Bitcoin's better than treasuries unless you come and like fix that risking point. and say, okay, he's like he's comfortable earning like, I don't know, 4 times his risk. And so, okay, if we assume that 4 times the risk is like a good value, then that will make sense for him to go on to Bitcoin. So like that's I'm sure you are familiar with like the concept of beta. Now that's not the end risk be all risk measurement. We have a bunch of different ones as well, but like the general idea is that like for the risks you're taking, you need to be compensated, and if that risk is higher, you would expect more returns. Now that's not always true in practice, but that's generally what you should have in your mind. So because of that, the like financial theories and the portfolio theories, like they have this concept of alpha. And if anyone could explain to all of us what alpha is, that would be great as well.
Is it the excess return from the overall market?
That is true. So the alpha is true. It is excess return, but one thing they try to include in the alpha is that they will try to like sort of control for anything else that's contributing to this, right? Like if you're looking at alpha through like a lens of a CAPM model, you're going to control for risk. You're going to be like, okay, this guy has this alpha, and that alpha is like a measure of the fund's skills or knowledge or whatever. Like that's because you're better than everybody else. That's not because you got like you're taking more risks or whatever. And like we have more sophisticated recent models that like the 5-factor models, and they try to like say like these stuff explain the returns, whatever else is there, like that will be the alpha. But the general idea, like whenever you see alpha, that's saying like the excess return, you're beating the market, and it's not because like you're just more of a risk taker or like a few of these other factors. That's what it's trying to explain. Okay. Now, sort of getting all of our sort of literature together, right? Now, for machine learnings to like predict prices and returns in the future, it's generally a difficult task. The first problem with it is like the machine learning algorithms assume that there is an underlying pattern on information in the data to be extracted. For example, in the Titanic homework that we uploaded, okay, we know that if you know like I don't know, the gender, the class of the ticket, and these 3 things, if you know these like whatever these features, you can like with a very high accuracy say who's going to live or die. You know that. You know if like you train a model on this picture of a cat quite a few times, that's actually a cat, and the model is going to be identifying it. However, when it comes to like financial markets, especially like considering that efficient market hypothesis, we don't really always know if there's a pattern there to be extracted. We're not sure if you can actually predict this like particular asset's prices. We really don't know. Sometimes it's easier, sometimes it's more difficult. And that's the point of it. There's like a giant proportion of noise whenever you're trying to predict returns in financial data. And like we have a giant like proportion of noise to actual useful information ratio. Think of it like even in your general like tradings, you don't know like, okay, does this news influence like the return of the stock that I know? Does that 10K influence it? What about this technical indicator? We have a lot of information, and a lot of it is just noise, and it doesn't really have any predictive power. And to make it worse, that's something like I think Matt and Brian pointed out in the first slide of our last class. You remember the model that used data from like 1960s and was able to like generate 30% returns. And one of you guys said like, what about COVID? We didn't have COVID in the 1960s. That's not going to be able to predictable. So, and that is correct. And one of the other difficulties of this whole entire approach is that markets are dynamic. The market of today is not really the market of 10 years from now or 10 years ago. These are like inherently different animals altogether. So that makes the situation even more difficult. And there is a competitiveness to this game too. Like there are like a lot of people exploiting these strategies, and competition in this realm, like using strategic systematic trading strategies and machine learning or general like strategic trading, means that you're gonna face a concept called alpha decay. Anyone cares to like jump in and give me an explanation on alpha decay? We're going to talk about it in a minute. So before I go to the like actual explanation, it's the same concept. Imagine if 3 years ago you thought Tesla was worth $600, but it was actually $50, right? And if everyone else reached your like mindset, imagine you had like whatever information, and that's where you got the $600 valuation, like 3 years ago. If like somebody else got their hands on that, if like I don't know, JP Morgan got their hands on that thing, they would trade on that too, and everybody else would do too. So your price, you will not have an edge anymore because everybody else is doing the same thing, and that phenomenon, that mispricing, or that, as we call it, inefficiency in the market is going to be priced in, and your strategy is going to be useless. Now, this is very like in general, it's an important concept in financial markets. Does that make any sense?
Is it similar to like arbitrage, the way it works? Like if more
Correct.
and more people, okay.
Yeah. That's the general like the arbitrage concept works the same way as well. Like whenever some things, there's an arbitrage opportunity, the idea is that, okay, people are going to take advantage of that opportunity. And if they do it enough, the arbitrage gap will close and there will be no place for profit. And that's the general, like if everyone starts doing the same thing, there's no longer going to be a profit. And that sort of explains the secrecy of these hedge funds that you see. That's why they don't really publish their like strategies and stuff online. It's not like every other like science you see where like people are collaborating and sharing and stuff.
Quick question on the
Shoot.
noise to information ratio. I guess since the market's not always the same in different time periods, who's to say that the noise now is real information in the future? How do you account for that?
Could you repeat that again, please?
Sorry, just in terms of the noise to information ratio.
Mm-hmm.
So what's noise today could be valid information a year from now. How would the machine learning account for that?
That's true as well. Like that's what makes it complicated. We don't really know. So the noise idea, like we don't really have a robust measure of like disinformation type as noise. But whenever you like your best machine learning algorithm has a like an accuracy of like 54%, that means what you have under the hood doesn't, the information, the genuine information doesn't really have much in it, right? And what you said like goes back to like we see this like in different trading strategies as well. Like whenever everybody starts using them, they become useless. They have no valuable information for a winning strategy. But like at some point in time, if people stop using it, there might be a winning strategy in there again. You see this in a lot of these accounting papers too, like I don't know, the accruals ones, like they were saying like back in the 90s, you could see a lot of these, they say like, if firms do this, they're gonna have reversal, and like the people, the firms this way are gonna like have worse returns. Like that was true in the 90s. It's no longer the case because a lot of people took advantage of that. If they stop doing that today, you might be able to make money off that again. That's the general idea of it. Now I'm gonna like further explain this concept by a personal experience I had, which hurt a little bit, to be honest. So for my undergraduate project, I was really fascinated with this like technical indicators, and I was like fascinated. Are you able to like predict future prices and stuff with these? Just basic lines and like a few simple equations. So what I did was like, it's very similar to the material we covered. I used a lot of like 20 technical indicators. We had the RSIs, the moving average conditions, the MFIs, the MACDs, the price actions, and all that stuff. And what I wanted to be able to see is like whether I can predict the price of gold will be higher or lower 5 days from now. That's all I wanted to know. Nothing else, just binary. 5 days from now, would it be higher? Would it be lower? Price of gold on the Forex was it XAU USD, right? And I think my best model was actually an SVM model as well. And I was able to like get a 60 to 63% accuracy in forecasting this. Just binary, not prices. I was going to be able, with like 60% accuracy, I was able to say, okay, price of gold 5 days from now is going to be higher or lower. And on larger samples, that the accuracy seemed robust at the time. And that was 2018, right? I actually sat down and we did try to like trade a little bit of binary options with this. Like I went and like worked a little with this like very small like quant shop. And the binary options is generally like you make a bet if it's higher 5 days from now, they give you 88% of the money. If you're wrong, they'll take 100% of the money away. It's just more gambling than actual like investing. But that was the thing that would work with this algorithm. Now, I tested this model actually, I think 6 months ago or something like that again. And I was curious. I wanted to see like whether it will still work or not. Now the accuracy of the same algorithm, nothing's changed, is 50% exactly. And the returns are diminished. Now there might be a few reasons for that, but like that's one of the reasons like I might be somewhat skeptical whenever I like look at the short-term technical indicators in today's world. I look at this, I'm like, okay, all of this is 50% now. It didn't used to be. It used to have some competitive advantage in the market. It used to be able to have some edge, to be able to make some predictions and make a profit on that. Does that make any sense?
Yeah,
Yes,
the
it
time
does.
for the updating time has changed.
Yeah. All right. So we have that covered. Now let's look into what are the data sources? Let's say you go to a firm and they want to do this, or you want to just do this for your own, and you want to see like what people are doing. We have the traditional sources of data because the main idea is like you need information that can predict the returns or the prices or the sales, whatever the why that you're looking for, whatever you're trying to predict. You need a bunch of information, and you have this belief that there's a knowledge in this information that a machine can learn to predict whatever in the future. Now we have the traditional like price histories, the technicals, the cross-sectional price histories, the analysts' returns, and the fundamentals. Now more recently, we're like with the machine learning becoming more and more advanced, we're like people are starting to like run NLP algorithms on like news feeds and on the company filings to like determine sentiments and stuff like that. That will give them an edge. And the general like idea of this like alternative data sources, it's becoming a like a more popular genre in this whole quant investing world, where they use like whatever is not traditional. It doesn't really have a clear-cut definition, but like they use social media. I believe we had a guest from D. Shaw last semester. I think like he mentioned this too. Like they were using like credit card information to like be able to price something about a security, like predict their purchases. Like imagine you would go to the Bank of America and tell them like, give me all your anonymous like credit card transactions, and from then you will be able to forecast the sales of, I don't know, Target or Walmart or whatever. Satellite images and all these stuff that, and the idea behind it is that like there's not much competition in this, and that's why it's becoming more popular. As we said, like the more the competition, the harder it's going to be to make a profit, and that's why the sort of the alternative data sources is gaining a little bit traction over the past couple of years. Now, after doing all that, and like imagine you have a winning model with an edge. Obviously, this is not a world where you can like predict with an R-square of 99% or an accuracy of like 80%. You have an edge. The next step is going to be like using that edge, because the machine learning model doesn't really give you a strategy. It just tells you an estimation of some things that's going to be relevant to your strategy, right? And the next step would be to like construct a portfolio around that machine learning model. For example, the binary example I did a couple of years ago, simplest strategy was like, go do binary options. It works for that, right? Now, the paper we talked about a couple of weeks ago, the initial paper, anyone looked at that, they had an R-score of 30% in predicting next month's return on like 500 securities or something, right? And imagine you have that. How do you build a portfolio on that? Any guesses, anyone? Yeah, I don't blame you. It's a complicated thing.
This is
right?
fully recorded, everybody, and you will share your slides, right, Laura?
I'm sorry, what was that?
No, to somebody else. Yeah.
Okay. So yeah, I don't really blame you. This is difficult. And the only reason I know the answer, because I was curious too, like I went and read the paper. So their approach was simple too. Like they didn't really do anything too complicated. They had like, I don't know, like 100 securities and their predicted returns. What they did was they longed the top 5 predictions of returns in any given month, and they shorted the lowest 10. Like they quantiled these predictions for each month. Like imagine the machine is making a prediction. Okay, we have a list of 100 securities. The return of this is going to be like, I don't know, 2%, 2.5%, whatever. It gives you a list and estimations. And all of these are estimations. And they sorted this and like long the top 10 and shorted the bottom 10. And that gave them a 27% annualized return over like a long period of time, I think 20 years or something like that. And that's very like complicated. That turns into the like the financial theory of the market, like the general simpler forms of it would be like the Markowitz portfolio theory, where you like try to diversify, control your risk, and maximize your return. And like there, some people are using like reinforcement learning and dynamic programming there as well, which I don't know, it's complicated to put it mildly, but this is like a difficult part of it too. Like that's what people are doing, and I wanted to like go over that as well. Now, another thing that we need to like talk about here is that it is extremely difficult to validate your model, right? Because let's say you have a model that works on a sample, right? What is to say that you just don't have sample bias? What is to say like you just didn't get lucky? That goes for your like backtesting strategies as well, right? It doesn't have to be a machine learning, it's just basic statistics. Imagine you have you have a strategy in your head and you go and backtest it for 6 months. How accurate is that? Would that work for a year? Would that work for 2 years? And to sort of make the matters a little bit more difficult as well is that whole idea of the markets are changing. The backtesting data that you have is really worthless after 10 years going back, unless for specific commodities that are very established. You can't really backtest the Google's strategy you have on Google or tech firms like before 2005 or 4. It doesn't really make any sense. So because of that, the whole validation part of it is a little bit difficult. And to sort of put it in the end, and like since we were going to talk about cryptocurrencies today, I sort of decided yesterday to go and develop a model to predict Ethereum's prices and build a sort of a simple trading algorithm on that, and to sort of illustrate why this thing is difficult.
And just to interject, he is doing it independently last night.
Yeah, I have no idea.
Yeah, where me and Hugh are up till 1 a.m. listening to YouTube recordings on blockchain. This is independent. Okay, yours. This is, I'm spooked.
Any questions so far?
I have a question.
Go ahead.
We've talked about reinforced learning. Isn't the assumption that over the course of 10 years, if you're continuously using a model that, I don't know, you should also be making adjustments so that even if 10 years later you're back testing samples or data sets or obsolete, that the model should still be current or working.
You are absolutely correct. That is like one of the like things to do. And that's why like the Citadel or like, I don't know, Medallion or like Two Sigma, they didn't close shop like 30 years ago and be like, okay, we have a winning algorithm, and they went away and let that algorithm trade. You're absolutely right. Like it needs to have constant sort of modifying innovation in terms of like what a winning model is, and taking all of these difficulties into account. The fact that markets are changing, the alpha is decaying, all of these things are changing. And the different firms have different approaches, and they are very secretive about it. But generally, like you have a thing in your mind, like, and okay, I'm gonna adjust this every 2 months, 3 months. And
Franz,
you get, go ahead.
I'm gonna jump in, but if you aren't updating it, aren't you just providing essentially static data that doesn't have any meaning to it down the road? Is that
Not really. Like the Ethereum example that I have here is just like, it's one of the reasons it didn't work was that like for example, like on the gold thing that we worked on, our initial model was static. It had a like a fixed like from like, I don't know, 2012 to 2018 training sample.
Yeah.
Somewhere down the road, we realized that like the 2012 to 2015 data was noise. So we only decided to use the last 3 years. We saw that it was having a better performance. And that was because the market back then was too different, right? And at some point, we then realized that you can't really fix this. You need to like move your training sets as you move forward. You can't just train it until 2018 and trade with this same train model in 2020. You need to move this training dynamic forward. Does that make any sense? You're constantly changing your training data and making it more updated in an ideal world.
Yeah.
And whether, does that make any sense?
Yeah.
And you have ways to get feedback, right? It's not like, it is sometimes like a black box, but sometimes you see, okay, my model's variance was supposed to like be this. I was only expecting this amount of like drop down in my balance or whatever. You have like indicators of it. And at some point you see like, okay, this is not what I accounted for. This is not the risk I assigned with. And you have indicators of that. And at that point you might realize and look at your model, okay, this thing is dead. This is not working that good anymore. And a lot of like, this is like a very open sort of research area. It's like, you have to be able to diagnose this thing. And that's very important as well. But updating it consistently, that's very important, because the markets change, data changes, even your data sources changes. Like imagine you have a static financial data model and you're one of these hedge funds, or you're just a single individual. And at some point, like 3-4 years ago, you're like, okay, Google has this NLP library and it's super cheap for me to use. Or like McDonald's like did this like financial library and it's super cheap for me to use. So you go and decide to add that to your model as well and see how it works. So you innovate in that sense. Any other questions? Or did that make any sense? Follow-ups? Let me know.
Yeah, that
Okay.
made sense.
Okay, cool. All right, so in this example, we want to predict the price of Ethereum, right? And I think all of you are familiar with what Ethereum is, right? It's just generally a cryptocurrency. It's different from Bitcoin, but it's generally like by the common investment realm, it's referred to as it's the second successful prototype of a cryptocurrency. It's referred to as the silver to the gold that is Bitcoin. I generally like it better, like the technology better than Bitcoin personally, but the like pricing wise, it's just like the second most relevant cryptocurrency that is talked about. So here, I wanted to be able, like for my I was generally curious. I wanted to be able to see, because I had a hypothesis and I talked about it a little bit in the last session as well. I was like, okay, these two, like Bitcoin and Ethereum, are very correlated. And one of my main underlying hypotheses here was that, can you predict the price of Ethereum 1 week from now by knowing the price of Bitcoin today? Does that have any information? Now, it started like that. Then I was like, okay, there might be some other useful information out there to use as well. And I went and like collected this from these Ethereum data sources. And these are basically my X features that you can see here. And I have the like this gas limit and gas uses. The gas is the general like thing referred to as the effort done to make a single transaction. Like he will talk about cryptos in more length, but that have at it as like a general like a cost of transaction and cost of making the number of address counts, the supply of ether, and ether is just the lower currency, like the cent to the dollar to the Ethereum, right? And we have the volumes and stuff like that. I have a bunch of the different these features. And I didn't really put that much time into this. So I just like, okay, these seem relevant. I just tossed it in to see what I can get out of it. And this is like a correlation table. And if you look at it, so RY is the price of Ethereum 1 week from a point. And this data is like for, I don't know, 4 years, 5 years or something, right? And you can see the correlations here. So obviously the price of 1 week from now is super correlated with the current price. That sort of was a given. But we can see it's also very correlated with the price of Bitcoin. So that hypothesis was not really that unfounded. That we can see here. And we can see that like we have a really bunch of other contributing factors, like the number of daily transactions and the gas use seem to like contribute to the next week's price. So I decided to like develop a model and train a model on like 70% of this data. And I had like reserved 30% of unseen data. I didn't look at it. The machine didn't look at it to be able to see whether this model actually works. And I used the exact same thing we talked about like in this class. I used SVM to sort of model this. And my first try, as you can see here, wasn't really that successful. As you can see, an R-square of -6% is basically telling me that I would be more successful if I just tossed random numbers on a board. But after trying to optimize this a little bit, I got a sort of a decent score out of this model. And this is just a basic SVM model, and with a polynomial kernel and a degree of 3. And this epsilon is basically telling the model that, okay, this amount of variation is allowed to have intuition about it. You don't have to be that accurate. And I got an R-square of like 76% on the test data and a 95% accuracy on the R-square on the train data, which honestly, I was surprised myself. I didn't think I would be able to get this high. But as we said before, there's like generally, it might not be valid at all. So the next thing I thought about was like, okay, let's build a trading strategy. Okay, I have this thing and it's predicting stuff. First, let's see how the prediction prices of this model compares to the market. Now, if you look at this chart here, the blue line is the prices that my model predicted, right? And given the X's that we had there, the gas, the previous Ethereum, the previous Bitcoin, given all that, right? And the red line here is the reality of prices. As we can see here, they're like generally very closely correlated and they're going in the same direction most of the time. So I was happy with this too. I was honestly surprised. But all that would mean nothing. Like that will be just pretty work if this wasn't like fed to an actual winning strategy in the market. And I didn't really this was only a day's work. I didn't really have time to like put anything sophisticated together. So I tried to simplify it. And I told myself, okay, if the next week prediction is higher than today's current price, go long. If it's lower, go short. Simple as that. And you start with a 5,000 balance. And our testing period is like from the mid 2019 to like current March. And oddly enough, I start with a $5,000 and I go close to $1 million. But the model starts crashing.
I'm glad you lost. You wouldn't be with us.
Yeah. The model starts crashing here around like the sort of the mid 2020. And after that, it never gets anything right. And it goes back to zero. So that's a sort of a quick way to gain money and lose them all together using my model. That's how.
One good explanation might be that the entire model need to have reworked after 2009. The key driver must have all fallen out.
That is true. That's one of the things that might be the problem. And like we'll talk a little bit about like what the issues might be, and I would like to like get everyone's ideas too. And I want to share one more results before we get into that discussion as well. And this is the one I did for like predicting the next day rather than the like the 7 day from now. And I wanted to like first get a result and show it to you guys. And see, we start from 5,000, but around the same time, model starts crashing. It doesn't work anymore, right? But another thing I want to illustrate in this here is generally, as like we all intuitively know, it's easier to predict a little bit longer period of time. Like it's more difficult to predict the prices like tomorrow compared to 5 days from now. Same goes for like 5 days from now to 6 months from now. Now you don't want to make this like price time period too large, because the larger you get, the less data you're gonna have, right? You can't really backtest the yearly strategy with only 10 data points, right? And we wanted to have that in mind as well. And Chuck brought up a good point, and that is one of the problems with this model. But what else? What do you think this model failed? Any other intuitions? I'm gonna keep it on the balance form, so you can sort of give me your insights on this.
I think maybe some other factors came in play after 2020 July. So that's like a new variable which kind of dominated the model, and you're missing out in the previous one.
That is possible.
Yeah, but yeah, I think it correlated. I remember that's June 2020. That's the halving date, right? The Bitcoin halving on June 2020. So that's like a diverging. Why do you see a lot of assets? They are not, most of the time, historically, most of the time, some assets, they like move in the same direction, very highly correlated. But sometimes you also see those assets like divergent at some point.
Yeah.
It's similar to what we discussed in the gold last November. Gold and Bitcoin be correlated for the starting from the 2020 and very correlated, Bitcoin up, gold up. But since the December or since the October, the gold price and the Bitcoin price divergent. It's more like a trading behavior, and people more, those people used to trade gold, they just leave the gold and jump into the Bitcoin. So it's more like some factors change the correlation, and that's why for those quant models, you need to revisit those models daily or like in a certain period of time to check whether you're going to train the new data and see whether the model fit to the new environment.
Yeah, that is a very good point. Like, I guess you kind of need to have this game sense as well. You need to like have some contingency plan, because you know your model is going to fail at some point in time, and like
The
you
key
need to
drivers,
develop a set
you
of
know,
okay, what does that failure look like? I'm sorry.
yeah, and in that asset class, right? So you're continually looking for substitutes for gold. The performance gold serves, right? Maybe I don't know, silver. I don't know. Because whatever the golds, wherever the gold-like store of wealth are not performing well, it might go very good or very bad for gold. Very bad in a sense, macroeconomically, all these commodities are not a good storage, or there's a substitution happening. And perhaps what Hugh is pointing out is the Bitcoin gold kind of substitution, the divergence talk.
Yeah, I think another one is when you build those quantum model, you need to have like circuit kind of point, like when you return down like 10% or 5% daily, then you need to stop trading and stuff, because everything traded is on the automatically through the program. You actually not looking at like watching the screen to see how your return jump up and down. But you need to have like circuit like program to set, okay, when the return jump like 10% a day, you're gonna cut off, stop all the trade.
For Farah, this would be great, because even if you put a circuit breaker, it wouldn't work. Look at the steep drop. The circuit would have flipped, but you would have gone to zero.
Model died here. You're absolutely right. Actually, like Hugh brought this up, I wanted to address this point as well. Like, you guys, like some of you might be wondering, okay, this is a computer scientist job, and like I'm not going to be able to compete in that realm. But the idea, like, you're only as good as the features you train, and there's a like this like whole area of like feature engineering. And I believe the like main competitive advantage that like the finance and MBA people are going to have in this realm is like what Hugh pointed out. Like, okay, in this time period, this happened, and you didn't take into account these features that affect the price, right? Finding these features is really important. You like your model is only as good as the information you feed to it. And I believe that's an area like where like the finance people have an edge over the general statisticians and computer scientists. Any other suggestions? What is the flaw? What's
Yeah,
going on?
Faraz, do you think that maybe there was another quant shop that saw this correlation just like you did, and on that day that you see the steep drop, they actually decided to start investing a lot in it, and then they changed the price of the cryptocurrency, maybe. Who knows?
The gold is too large a
Possible.
market for one shop to do it.
Yeah, that is a possibility, but I honestly think the model's too simple. Like if quant shops are doing this, like we like yeah, they need to go out of business. Like if they're using the same model. Right? If something I can develop in my room in like in a day. But yeah, that is a good point. But that might be the case here, but that's more apparent in like in these more sophisticated models. If you go and read these asset pricing papers, it's very interesting. Like all of the returns they have, like no matter what anomaly they're trying to expose, like it's returns with fundamentals, like NLP sentiments effect, or like accounting, whatever it is. If you look at it, like it's just like a logarithmic thing. It goes up and like turns to zero. Like it has at some point it has no information anymore. And that's very reaffirming to that point. Well, thank you, Valentino. You actually gave me too much credit, like with saying that. Anybody else? Okay. I have a few thoughts on it myself too. I guess I'll point them out. But like, I didn't really go through and like test these because like you can really do more analysis on this, like to diagnose your model and see what's going on. But I have a few ideas and I wanted to share them with you. The first thing is like the model's too simple, if you ask me. If I could be a millionaire with like half a day's work, that's not how financial markets work.
Could you please tell me first before you tell that to anybody?
What was that, Chuck?
I said, if you can become a millionaire with half a day of work, I would like to know it first before anybody else. Please.
Yeah, true. So
that'll help.
Yeah, that the general, like that's why we talked about the market efficiency part and the fact that like it's difficult. It's not supposed to be this easy. And that I think the model is to if we tested this model on a like I don't know 10 different cryptocurrencies and we saw like a decent R square, so like it's still working with those as well, my confidence will increase in this thing. I'm gonna be like, okay, there might be something to it. But like with just testing it over like one sample and like just one SVM line, I'm a little bit more skeptical of it. And I think it's a little bit too simple. One main thing that actually like might be like I've faced this before, and I think that might improve the model is that the training data is fixed here, right? And we talked about this in a couple of slides back where like we said, like we need to adjust and you need to move your training sample to more recent data. So our model here is using data from like 2016 to 2019 to predict this point, right? It's also using the same data, like 2016 to 2019 to predict this point. It's also using the same data, like that old data, 26, it's not updating, it's not incorporating the retraining the model here. And that I didn't do that because it's very like computationally costly. It takes a while to do that, like train your model each day, right? And so like I have a feeling the further I'm going away from that training point, this like initial data is becoming more and more irrelevant. I would be interested, like one follow-up experiment if I was to do on this, I would train the model here in this like from, I don't know, 2018 to 2020 and see the performance here and see whether if anything's changed. If that is the issue, that should fix it. And what else? Yeah, the streamable model is exactly what I just said there. And another thing is like to build a better portfolio. You pointed this out, is like you need to have an exit strategy, my friend. You can't just go in and trading and like don't have a bottom place where you like decide to leave the market. Like you need to have stop loss, and you need to have a take profit. You need to have a strategy of like, okay, if like this is the time the model fail. And if like the portfolio, like we didn't really have a portfolio this time, like a trading strategy was designed better, the performance might have been better. Any questions on this or points? Okay. All right, so I'm gonna mention one more thing and I'm gonna wrap it up. We saw that like we mostly talked about the difficulties. We saw a little bit of how the approach is and what are the elements to it. Now I want to talk about something that's like, this is very important in the industry. And that's the general trade-off of this whole sort of machine learning approach. Now, we established this is difficult and it can be very computationally heavy. Now, we like 4 years of Bitcoin or Ethereum data is nothing. That's irrelevant. Like to like put this into perspective, Google had this project AlphaGo where they trained a model that could basically beat any human in the game of Go, right? And that was the sole purpose of that model, just that. And but it would like adapt. It would just like it would learn. It was a reinforcement learning approach with, I think, with an initial deep learning model. And estimates right now, like some people publish some estimates, is like to replicate the initial model, like to like train that model from like bottom up, it will take about like 20 to 30 million dollars in terms of processing power. Like you would go on Google Cloud and like get GPUs and TensorFlows and stuff like that just to process that data. So there are costs to this. Like if a firm decides to, especially like whenever we're talking about like large corporations managing like billions of dollars, right? And so whenever like you, if from a firm's perspective, from a hedge fund's perspective, this is like an investment for them. You invest in like training this and like getting people to work on it and building this strategy, and you'll break even in like, I don't know, 6 months, 2 months, and like you'll make a profit after that. So there's an initial cost to this whole thing, generally speaking, especially in big applications. And the another main constraint in this like whole approach is the transaction cost. Now, the normal regular transaction costs have been dropping for ages thanks to technology and like computers and stuff. But the main transaction costs associated with these like hedge funds, especially like people with big money, like anything, I don't know, above $1 billion or something, is the fact that like they might be influencing the prices themselves, right? There's a transaction cost to that. Imagine if you think something's underpriced, you put 10 billion on it, and like you move the price up yourself, and you like basically cutting your own profit. And detecting that is like measuring this, like this sort of thing is very difficult. And there are a few like interviews I was reading from the managers, and like they're saying the best performing hedge funds have a very good understanding of this portion of it. They know how much they're influencing their prices. And the general idea is that like they need to trade off with this, like how much the scale of it, how much the processing of it. But obviously the transaction cost goes to the larger numbers. And like if you're trying to develop a niche application like the one you just saw on my Ethereum project, or like imagine if you have a niche application on some other thing, that's a different story. And to summarize the whole thing, I think I would label this presentation "Machine Learning in Finance Difficult" generally, and that's what I've been saying mostly. And they have all these constraints, but have in mind that they're still helpful. Like it's better than no quantitative approach at all. Like it helps you to like at least nullify the things that don't work, and it gives you a grounds to stand on with something. Like for example, like this is why I'm currently a little bit like skeptical of like technical indicators, because I've seen it in my model. Okay, I don't see it. I can't see how like this is not giving any signal to the like my machine learning model as it used to. So like what is it predicting? I also like back tested all these like RSI and stuff like that. I saw like there was no statistical significance with all these like famous applications. So like whenever like in 2020, 2021, I would hear like technical, I would be a little bit skeptical. And that's the tool that like the machine learning gave us. And like mixing these tools with your non-quantitative views can also be helpful. That's generally for your personal use. Imagine you have the view of the world. You think, I don't know, like you think if oil prices go to a certain degree, like your I don't know, renewable energy firm is going to do that. You have a view of the world and you want to express that. The machine learning bit will give you a tool to provide some estimations to determine, like it doesn't help you gain that view generally initially, but it will help you to have that. Like for example, like you have an initial idea, okay, if the sales of this goes up, the price is going to up, like the simple linear like relationship between these things. You can technically predict the sales a lot easier than predicting the actual price. That's generally the easier approach. And that can help you in those sort of niche cases. And also, I've mentioned this again, like there are easier problems to solve that could help investing. That is another approach, like from the number of customers predictions to a bunch of different stuff. With that said, I will wrap up this presentation. Any questions, comments, anything? You're welcome to jump in.
I think from my